Chicago. Thanks for stepping in for Elliot today, Thomas. We're here to take you through the rest of this hour. Futures market closes at 5 Eastern, 4 Central. If you're joining us on the platform, Tasty Trade, if you're on the website, tastylive.com, thanks for tuning in. Come over to YouTube. Tell us what you think of today's action, what you think of the rumors that Fed Chair Powell was resigning, only for that to be an AI-generated dupe. The market did flash down a little bit weaker, only to rebound immediately thereafter. And outside of that, it was a fairly unexciting day in these markets where tech stocks were down a touch, NASDAQ off by about 0.5%, S&P treading water, the Russell leads the way higher with healthcare getting a nice little bit of a bounce leading sector today. Bonds continue to show signs of improvement at the long end of the curve, which may be one of the reasons the dollar is struggling here. And Dylan, we're going to have to draw into question our dollar strength hypothesis at this point in time. Tough. But it's been good news for gold and silver. And that's probably good news for the three of us. Outside of that, energy churns. Guys, we are getting ready for, well, the second half of this week where we have some interesting earnings coming up. Google, Tesla, IBM on the docket for tomorrow. Dylan, I apprise you of these rumors that the administration is trying to convince people that Fed Chair Powell is going to be resigning momentarily, any minute. Why are they doing this? Why are they forcing this narrative on the market, despite Powell's insistence that he's not going anywhere?
So my speculation, I obviously don't know why they're doing this, but my speculation is this. I believe that they are aware that the tariffs for which they advocate and have implemented have had an inflationary impact and represent a drag, a slowing effect on economic activity and an increase in inflation. Targeting Powell as a bad Fed chair or as a Fed chair who's not doing what he's supposed to do is a way, in my opinion, of distracting from the consequences of the tariffs. It's basically the Powell targeting is a way to redirect attention away from the negative economic consequences of the tariffs, meaning slower economic activity and higher inflation, by assigning responsibility for the economy or any negatives in the economy to the Fed chairman and suggesting that if the Fed chief would simply reduce interest rates, that the tariffs would be able to advance without causing any negative consequences. And so I think that the reason that they're targeting Powell is, one, as a way to distract from the negative effects of the tariffs, and two, because there's a constituency of people that are inside of the MAGA base that are also aligned with the idea that the Federal Reserve is a nefarious or illegal or misguided organization that needs to be confronted anyway. So there's the political points of sort of going to war with the Fed, irrespective of economic considerations. And then there's the icing on the cake, or sort of the primary motivation even, which is to redirect blame or concern about any weakness in the economy away from the negative consequences of tariffs and point it to the Fed chief. So I think those are the two primary motivations to do it, although I do wonder whether a lot of the folks that are actually doing it even know why they're doing it, other than the fact that they're doing it because the president did it, and they're just sort of mimicking the president's behavior at the end of the day.
Thomas, we find these headlines to be ridiculous and pointless. I'm getting to the point where they're getting a little tiring from how they're continuing to flood the market. The market didn't react that seriously to them today. Again, it was a brief little bit of a pullback here. That's this on the chart, the 2:15 p.m. candle. What are we doing here? I guess, like, how do you even react to this? Because it seems like day traders just completely look through this today and we're happy to buy the dip.
Is the 2:15 candle the fake Fed press release or whatever it was?
Yes, Mike Lee and MAGA World Media, Benny Johnson and the like.
Yeah, I mean, it's easy to put Fed as the scapegoat when a certain portion of your followers already sees entities like the Federal Reserve as this ominous cabal of government conspiracy. But it's interesting, you know, it's like when Twitter got first taken over and you saw fake tweets from companies that would actually impact the price. But when you looked at the press release, it was pretty easy to see that was fake. The logo was just gibberish, things like that. But I'm surprised there was even
Thomas,
a
do you
reaction
think you
at all.
agree with my reasoning?
Yeah,
do you think there's another
I think
motivation?
you're spot on.
Yeah, this was the logo, by the way. This was being passed around as legitimate news today.
I mean,
you zoom in
it
for
almost
a quick,
looks like Latin. I mean, I guess the top.
This is, if you've ever used ChatGPT to generate text on images, this is the kind of crud that comes out of the system. And forget the fact that like the leafs here. I mean, just the whole thing. If a U.S. senator is retweeting this information as legitimate, we are so cooked, Dylan. We're so screwed.
I mean, but do you think that the U.S. senator is doing it knowingly or unknowingly?
It's hard to even tell.
I don't think it's hard to tell now. Yeah, I think that's the case here. But where the market bottomed out today around the news and where we found our low today, I think is the more interesting conversation, because we never crossed a key technical threshold in either the NASDAQ or the S&P. If we're to believe that the previous trading range in the NASDAQ was 22,800 up to 23,100, about 300 points wide for the bulk of July so far, we find support today at 23,108, pretty darn close. Not going to fret over 8 NASDAQ points for an exact touch. So the uptrend is thus far maintained off of the low that we have here on June 22nd and again on July 16th. You can say the same thing about the S&P 500. We haven't exactly cracked into the previous trading range. And then our beloved Russell, our favorite 2,000 companies in America, they find support at the uptrend from the April, those June swing lows so far. So stocks aren't out of it right now. I'm not leaning any long deltas in equities, though, here, Dylan. You seem to be much more confident still to continuing flying close to the sun. I've decided to take my parachute before my wings melt off. How do you view the stock market?
I just like that. I'm with Nikki Batista from yesterday, where I just think that the earnings cycle and that the earnings headlines and the earnings guidance and the sort of the nature of the companies that are about to report all represent a fairly positive, a buoyant force for the stock market, I guess. And so, I mean, that's the essence of my continued optimism, is that, you know, we, as I mentioned yesterday, we sort of moved through the inflation data, and we're teeing up what I think should be some fairly positive earnings reports from some of the biggest names in the technology space.
Thomas, I know that you take a little bit of a closer, more granular look at individual companies' earnings than I do, and we certainly do have some important ones coming up here down the pipeline. Google, IBM, Tesla over the next day or so. That really kicks off our mega cap tech names. What interests you more at this juncture? Is it what's happening with Tesla? Is it what's happening with Google and their AI? Or are you looking for trades in either of these particular companies, or more as bellwethers for the broader NASDAQ?
I mean, I have a short put spread on in Tesla. I'm going to hold it through earnings. I like Tesla for an upside play because it hasn't participated in the rally, you know, compared to some of the other big tech names. And at this juncture, I think it just needs to avoid a worst case scenario earnings report. As long as Elon Musk says something positive about robotaxi or something, it's not going to matter, you know, what the numbers really were, unless they were really, really off. The market just wants to, you know, the robotaxi thing is the big thing right now for Tesla. I think it's going to go up after earnings. It's been kind of a laggard here for a while. And in this environment, you know, if the rally is going to continue, I think Tesla has to catch up at some point here.
Dylan, I'm thinking about our point of view going into the previous earnings report, which was effectively, things have been so bad. I mean, check the tape, right? They were firebombing Teslas, as we noted. So the negativity was basically baked into the stock price. As long as the company remained a going concern, how much worse could the news flow get? Since then, after alienating his liberal customer base, Elon Musk goes into politics, and he then crashes out calling Donald Trump an pedophile on Twitter very publicly. So I don't know if we should be expecting a lot of positive sentiment behind the Tesla brand still in the second quarter. I mean, I have a very low bar here. I'm expecting another disappointing quarter in terms of actual sales, Thomas. I think you've nailed it. I don't think the numbers are really meaningful whatsoever, as long as the company's staying in business. I mean, that's how low the bar is in my book. And if they have any glint of positivity towards AI or robo-taxis or Optimus, the market's going to be looking for a new point of speculative interest. Dylan, I know that you've been playing Tesla in the past through short put spreads as well, which has been obviously very efficacious. Do you have any strong opinions on it here now that it's trading at 332 ahead of earnings?
I mean, it's kind of boring, but it's really the same opinion, which is put spreads going into earnings, with a little room for error on the south side, so not too tight. But there's no way Tesla's going out of business, and there's no way that the most recent quarter was as bad as it may not have been significantly better than the previous quarter, but that report 3 months ago was such a horror show that it stands to reason that even if this is not great, that it will be slightly better, and that the belief probably is that as more time passes, that the half-life of the memory of the Musk participation in the government will continue to rot out and work to the benefit of the company, and all those play towards the value of selling some put spreads with some room for error, I guess.
Not just Tesla tomorrow, but Google as well, which despite the NASDAQ sluggishness today had a very nice performance. The NASDAQ was down by about 0.65%. Google was up by about 0.65% here, so a little bit of a mirror image going. Google's had a nice run, though, and volatility is creeping up, a 40.8 IVR. Dylan, it's not Apple, but it feels like Google and Apple have been the two FANG names, Mag 7 names, that outside of Tesla, for those obvious reasons, these have probably been the two more disappointing stocks of that group. If we can get Google and Apple over the hump, is that really the key for the door for this next leg up if this rally is going to continue? We need the behemoths to punch above their weight again.
I mean, yes, but I think I think the short answer may be yes, but I also think that there's more than one way to get there.
Okay.
So that's one version of it. But listen, the best thing would be for Apple to show some signs of life, because I think it's the most disappointing of the group. But also, if Apple doesn't show any signs of life, as a stock, it doesn't mean it's going to be a problem, particularly when you have so much activity available from Tesla, from Google, ultimately, even from Meta and these guys, even though they're not reporting right now. So I don't know. I guess, yeah, Google, let's put it this way. Your best case scenario is a beastly guidance from both Google and Tesla. But even if you don't get that, it's hard to see how these names disappoint or how the stocks get blown up at this point.
Thomas, tech stocks today, they were the underperforming group. They were down by 0.93%. Semiconductors, which I know you've had an affinity for in recent weeks and months, were down by 1.77%. One, I guess the question is, are you still involved in the semi sector? Do you have any trades on there? And two, if not, does this pullback to its 1 month moving average today, is that enticing enough for you to start engaging on the long side again?
Yeah, there was NXP Semiconductors had a bad earnings report, dragged down the sector a little bit today. I look at pretty much the same thing as you. The 21-day EMA, we're right there. I think it's a decent place to buy, especially as we move more towards the second half of the earnings season with NVIDIA. Yeah, I think you look at the chart. This level has held several times on pullbacks. So if you're going to get long, I think here is a good place to do it.
You mentioned that against that 1 month moving average in recent months, particularly since the low that we had here in April, it has swung up to become a point of support. Maybe this is touch number 4 in the market, but we've seen, once you get that cross here in the fourth week of the month, you get that elevation in semis. So perhaps today was that swing low. It really looks nice if you're operating on the long side. I think that's the 281 level. We'll call it 281, 282, as long as we're above there. Longs still feel somewhat comfortable, even if we've given up some of the gains rather. But the semiconductors were one of two indexes, or rather ETFs, that were lower on the day for the sector performance. Our top performers were all related to home construction as long end rates continue to come in. ITB was up a whopping 7.88% here. The housing market still seems frozen, though. Existing home sales, those are coming out, but we've seen the housing data in recent months sour. Dylan, I want to throw out a different angle on this because I heard this throwaway comment yesterday, and it got me thinking, and I brought it up with Tom and Tony this morning, but I'm curious about your view. Speculative capital is always going to find a place to go. I feel like for the past several years, people have been waiting for the housing market to clear, for rates to go lower, or for prices to drop so that they can deploy capital back into housing. But for existing homeowners, if you've been waiting for rates to drop because you have a sub 4% mortgage, you've actually been able to save up a little bit of money over this time window. Maybe you were planning on moving, maybe you weren't. So what if there's a realization that because of all the tariff policy that rates are going to stay higher for longer at the long end of the curve? We're not going to get another significant pullback in mortgage rates unless there's recession. So might as well dig in with where we are right now. We need to start deploying this capital in other places if we're not going to use it in the housing market. We're going to put it into the bank. Out of the bank, we'll put it into the stock market. If it's already in the stock market, we're going to take risk. We'll go into crypto. Do we think that maybe some of the recent market moves, if it's the gamma squeezes that we're seeing in some of these meme stock names, if it's the continued push higher by stocks in the face of ridiculous headlines, is it because there are portions of the economy that are broken and capital has no other place to go but into the speculative areas now?
I mean, I suppose so. What I was just thinking about is whether, because your premise is that there's a bunch of money that's basically been waiting to get more involved in the real estate business, yes?
Let's start there.
And that it's been waiting for lower rates or lower house prices, neither of which have materialized.
Correct.
And that it's sort of reaching a point of exhaustion where you're not, where you're excuse me, you're never going to get lower prices, or not in the immediate or intermediate future, nor are you going to get lower rates.
Right.
And so you're saying now they're going to untie the camels and head for another hill.
Maybe that's what's been going on in recent months with crypto, with the equity market.
Money that would have otherwise gone into real estate has come over. Could be.
Is that not so
how do you
different
explain those
than
short
2021?
squeezes? How do you explain those crazy shorts, that one crazy short squeeze yesterday?
Oh, these are some of the hallmarks of a market reaching exhaustion, right? When pigs fly, because you can't get a good risk-adjusted return by making your typical trades. So you have to start going into portions of the market to punch lotto tickets. And if you have the capital to participate in a gamma squeeze type of situation, then it means that you probably have excess trading capital sitting around.
Meaning because you're allocating it into some real sort of, edge positions, basically, i.e. short open door technologies.
Right. Like I've accomplished enough of my year-to-date performance goals that I can afford to be a little bit risky with a small bit of capital. And if it goes sideways on me, no big deal. It's not going to really detract from my overall trajectory. And finding alpha in this market when everyone's long gold, short the dollar, and piled into the Mag 7s, it's all the same trade. So unless I want to be a contrarian and fade the world, I better be right with my timing. There was a really interesting tweet I saw that kind of triggered this chain of thought. It was from this guy who goes by the name of Clouseau Investments on Twitter, which can't speak to the efficacy of what they say, but I thought it was an interesting comment. Not calling a top here because of AI, yada, 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 but White House eliminates day trading regulations, poly market returns to the U.S., Robinhood enables 24/7 trading, The architects of the 2022 SPAC bubble are posting. CNBC guys have a crypto treasury play, and Wall Street bet meme stocks are crashing 40% from their highs. If you blow up later this summer, can't say there weren't signs. All I'm saying is what's going on is pretty crazy. It does feel kind of like 2021 in some regards here, where we're just running up in the face of what seems to be preordained misery, if it was inflation coming around the corner then, or whatever these tariffs are going to be.
But are you suggesting that this is also some sort of a, last gasp of bullishness before some abominable reality check emerges in the months ahead? Are you suggesting that reality check is the headwind of the tariffs that we saw in June is not just a one-time event, but rather is a broader economic underlying variable,
Thomas,
the likes of which Ilya Spivak would quite delight in?
I think that's what I'm saying, Thomas. I saw that we announced an agreement with Singapore today for our tariffs. President Trump has announced that instead of levying a 20% tariff rate with Singapore, the negotiations have yielded a 19% tariff rate with Singapore. Are we underestimating the risk that August 1st comes and Trump allows tariffs to go into effect for a day or two at these higher levels to make a point that he's serious, that he's not a chicken?
You're saying let them go into effect for a couple days and then extend them,
and then say like enough progress has been made to provide another 90-day pause.
I mean, sure, he could do that, but the market reaction, I mean, he doesn't want to see the market go down and then reverse that, because that taco thing is going to come back. And I mean, is he going to want the optics of people saying he chickened out because of a market reaction? So, I mean, when does the market start to price this in if tariffs actually, don't get that pause? I mean, the biggest risk is inflation actually coming up, rate cuts getting pushed back, and then a recession coming on. And then all this exuberance, is the last breath. So I don't know. I think as we get closer to August 1, the market's definitely, I mean, pausing up here, if you could call today, just today that, but I don't see the market getting too fearful just yet of, this August 1st deadline. But we've had deadlines before and, flip-flopped either way. So it's hard to forecast what he's going to do.
Hard to forecast. I just don't have any confidence leaning long here anymore in the short run, which, given the pullback that we've seen in the NASDAQ over the past 24 hours, good timing to get out when I did yesterday. I see a bearish rising wedge up here, guys. I see a market that if we break below 23,100, this thing opens up a trap door for an easy 1%, 1.5% loss down to 22,800. And then if we lose there, it's stepping stones, 22,600, 22.3. 21.5, 21.6. And then August is a month with low liquidity, typically low volumes, but when there are bad news, they tend to be exacerbated, like we saw last August. I don't know, it just doesn't feel too hot right now. Even though we're so close to all-time highs, and the S&P technically did close at an all-time high today in the daily chart. Doesn't look pretty, but we got there. All right, let's move off of stocks here. We've talked about them for the first 30 minutes. Let's move into the fun parts of the market where I think a little bit more money is being made today. Thomas, silver is working out really well here. I think that you and Dylan have not been involved in this trade as much as I've been recently, but the metals overall are working, and you're a resident commodity expert. Is today just a function of weaker dollar, lower yields, metals up?
Yeah, I think so. And then you're getting the equity markets flat, so perhaps some money moving into silver and gold. I've been participating in silver for the past few weeks. This is the first week I don't have a trade on. Of course, I'd want to be in for this move. But if you're thinking that the dollar rebound is actually done and we're going to go and retest the early July levels and then potentially move even lower, silver, gold is, probably one of your surest bets to take advantage of, that kind of environment.
And is that what you think's on the table? Do you think that more dollar weakness is in the future, Thomas?
I'm not too confident that the bottom was in earlier this month. I think we could, make a move back down DXY like 96.4 around there and break down through it. If you're getting a loss of confidence, the sell the U.S. trade coming back if these tariffs go back on, concerns. I think the dollar can move lower. The only currency play I'm expressing that view on is long British pound. Yeah, so I'm not going to bet on it too hard.
Why the pound? Why the pound of all your options? Why the pound?
Oh yeah, next question.
I think it held at its late June level. You got a little bounce there. That's kind of where I got in last week, right where you were trading at the late June swing low. But the British economy, it's already been in trouble for a while, and now I think it's a little more ahead in the cycle versus the U.S. of going into an economic situation that, especially concerning debt, is untenable. So now those concerns kind of coming out or not coming to fruition as much as they were feared. But mostly it's a technical play. So I don't like the yen as much for that. And I was long yen up until a few weeks ago. Christopher got me out of that trade, but I don't think there's too much of a distinction between being long the pound or the euro. Either one I think works.
The pound is an interesting setup here because it did just get back above its 1 month average. You mentioned the move off of the late June swing low, which was a bullish engulfing bar, and sure enough, that's where we find the low. And perhaps the more disconcerting thing for dollar bulls, good news for dollar bears, the uptrend from the January, February, April swing lows. We crashed below that this last week, only to retake it today. And we're closing back above the 1 week and back above the 1 month. So check. The dollar looks in trouble from that perspective. It looks in trouble from the euro perspective. Dylan, I hope while you're overseas, your paychecks are in euros, not in dollars this year, because it's not good otherwise. And we find our yen. This is bad for me. Second day in a row, political unwind. Thomas, I am convinced that this is just a political unwind. And none of the problems that the yen had accumulated over the past few weeks have gone away. Would it be silly of me to dig into my pockets and go buy some out of the money yen puts here? Maybe play this both sides of my mouth, get short the yen and maybe long the British pound like you?
Yeah, I don't really like trading a currency on, a political situation, avoiding the worst case scenario. I think it's going to return to its previous downtrend and kind of break that level from back there and having trouble reading the monitor from all the way back here. But the lower support line you have drawn on there.
Basically just north of 0067.
If we break under there, I think you could see, the losses accelerate a lot faster. You mentioned multiple times how it's a crowded trade right now. So you have to get an unwinding of positions at some point, and breaking that support level would probably, cause rush for the door.
Dylan, the charts don't lie. We can't ignore the fact that the dollar index is breaking down again here. It feels normal, though, because yields are going down this week. So the past 2 days, I could argue that it's just simple dynamics of how the FX market's supposed to work. But gold up, dollar down. You said Sell America's coming back. We don't see it in stocks or bonds yet. What's going to be the catalyst that breaks us out of this stupor? Because it feels like we have climbed the wall of worry and continue to ignore worries when they try to get added back to the wall.
I mean, I just wonder to the degree to which you kind of hit on it earlier, where I think that what's today's date, July 22nd or something like that?
Mm-hmm.
That as we get closer to the tariff deadline, that the market starts to incrementally increase the pricing around the probability that maybe the tariffs really do happen, or maybe the tariffs really are, more consequential or at higher levels than we hoped. And I think that the place where you see the tariffs obviously manifest the most is in the U.S. currency. And so I just wonder the degree to which there is another kicking of the can or a negotiating of the deal or a reconfiguring of the structure of the negotiation or however they say it is, that the actual implemented tariff rates on August 1st, once again, do not end up being particularly consequential, and then the degree to which that becomes the big dollar catalyst, particularly in a world where rate cuts are being delayed, not accelerated, which is not to be underestimated, and as a dollar support.
I think that's a good point. The market started moving in late March to price in Liberation Day, did it not? And the dollar started to get a little bit weaker, and the gold started to go up a little bit more. That was late March. If we're going to draw a corollary here, thinking that late July is like late March, then gold gets a little bit bid here for the next week. Dollar maybe comes off a little bit more until we get an official can kicking. That is. But if you've been looking at how this market's behaved otherwise, why not 10 days out from this deadline? Why not have a little insurance in your pocket? Which I guess brings me to what's happening in the S&P, because if we go out to August 1st, that Friday, and look at something like long the 6,200, short the 6,175, so a long out of the money put spread here, and whoops, we don't want to do it that way. We want to do it this way. Okay, risking one to make 7, 6, just as some insurance in the back of our pocket if Liberation Day comes around the corner. I don't think it's the worst thing in the world. Just the fact that the tariffs today, shocked that this was being bandied around as a victory. What if it's the same thing with the EU, right? Or Canada? Instead of 25%,
you're saying shocked that 19% was seen as a positive resolution in Singapore.
Yes, because from my worldview, I don't think tariffs are the most beautiful word in the English language. And
the market's at 5 to 10% expectation. So anything north of 10% that actually happens is alarming, basically.
Yeah, and I know the market's very much thinking like, okay, Trump's going to do 10 to 20% and we'll all move on. But there's a difference between a 10% tariff and a 20% tariff.
Indeed.
Or a 19% tariff. Has
huge
economic consequences.
Yeah.
So liquidity is not great right now. It's not fantastic, but time of day. But it's not terrible. Let's get some insurance in our pocket. We'll get this order working. If someone wants to give it to me that quickly, doesn't make me feel great, but I'm more than happy to take it for them. Little downside protection. I already have S&P 500 put spread out for the end of August, which I guess is slightly different, assuming the China deadline on August 12th. Is that going to get kicked down the road? August could be crazy. I'd rather have something in the equity market that leans short.
So what date are you going to lock in for your insurance policy for August? Why don't you take all of August?
Well, I have all of August. I have now August 29th and now August 1st. So I'm covered on both ends. I just think it's prudent. The market feels a little hot, and I don't like saying that as a bull, Dylan, because I've made my name with you over the past few years being the bull's bull around here.
And so what is it? Is it just the chart, just your technical view of the pattern of the charts that gives you anxiety? Like, is there anything else other than, like, why do you feel the caution?
The seasonality of the market. I can't think of a time in the past few years where August and September have not brought about a market decline in some form or fashion, or at least a pausing of the rally.
Mm-hmm.
And with volatility near cycle lows, as we see from the VIX or VIX futures, we can go to VIX or /VX. It just feels like everything is priced for perfection. So I'm not selling out of my long-term holdings, not at all. It's just I don't want to lean long deltas in my equity book at the moment. Unless it's the one thing that we've been talking about here recently. Well, two things. We did yesterday discuss the short squeeze potential for some companies. One of the names that we checked here, maybe some people took a gander at it themselves because the short float was over 50%. Rocket companies, they were up 6.45% today, Dylan. So, thinking about the signpost, testing our theory in real time, if pigs are flying, then it would mean that we're late cycle in this bull run because people are chasing crap. Today, we got more evidence of that. It wasn't just Rocket, but Kohl's was up 60-something% earlier today. This is a company with a very high short float in the high 40s. A bunch of these companies had performances like this. Let me just pull up my list once more. Who was the Locify? I've never heard of them before today. LCFY, Locify. They were up 19.8%. That is the most shorted stock in the country right now, for what it's worth. Children's Place, that has a 49.95% short float. That was up 33% today. AirSculpt Technologies, that has a 49.21% short float. That was up 12.5% today. I mean, you're seeing it everywhere. Riley Financials, this has a 46.32% short float. That was up 15.2% today. So it's not just Open, which is the name that's getting everyone's attention here. There's lots of things that really don't look good and are shorted for a variety of reasons that are just flying off the wall. Beyond Meat, BYND, Beyond Meat. That's 2.93% today, outperforming the broader market. Or Groupon, that was up way more earlier. We'll have to double check those numbers. Dylan, this is my point, though. There's a lot of things here that are very shorted right now that have no earnings. They have small floats. They're not doing anything other than squeezing to the upside because people are pushing around the market. The dog is being wagged by the tail. The tail's wagging the dog, as they would say. Late cycle, bull market kind of thing. Should we try to take advantage of it, though? I mean, we talked yesterday, Rocket, the $16, $17 call spread to the $17, $18
And what
call
happened
spread.
with that today? I didn't look at that chart. Did you see what happened with that today?
Yeah, 6% higher. Very
So
nice.
it worked.
Oh, yeah, people are trading it on it,
It's all like collaborated on Wall Street bets, right? This is like a crowdsourced, meme stock. Go towards the ones with the high shorts.
Yes. That's what's going on here in the market. Yesterday it was a 5-to-1, Dylan, like risking $19 to make 98. Today it's basically still a 2-to-1, the 16-17 call spread, 17-18. It's about 3-to-1. So the odds are coming in, but the squeeze has worked. I wish I was participating as much as I'd like to be. Obviously, I'm not long Kohl's or Locify right now.
Sure.
Well, you're not on Reddit enough.
No, I'm on Reddit every day. And as a former Wall Street Bets moderator, I spend far too much time around that shithole. Okay. But
really? We're going to go to that location.
Yeah,
I thought I was the only one who did that.
Dylan, you can only get so many messages from people like wishing ill upon you and talking about your wife's boyfriend and how they hope you never get chicken tenders for the rest of your life.
Before it just becomes a straight up shithole.
It just breaks a man's brain. Like, I'm not doing this for free. GFY, good for you. Okay. But yeah, I mean, Thomas, people are posting these names in there and people are crowding in and everyone is crowding in and the tail's wagging the dog. Open being the primary name, and even the folks like Eric Jackson, they had him on Bloomberg Radio this afternoon for their Into the Close report, and he's the person who's been pumping Open. I just think I know Tom would say when volatility is low, it's a good time to get some powder dry. I don't always agree with that. He's the boss, though, Dylan, right? This time I'm going to say that I'm not going to disagree with him publicly. As much of a risk to that as my job as I feel it has been in the past when I say, no, keep buying. This thing's fine. I don't feel like it's fine anymore. So I flew too close to the sun this week. I got out yesterday. I'm done playing long until Labor Day. Hold me to
And now
that,
you're
guys.
buying insurance or you're speculating on a decline? And what's the difference?
Both. Buying insurance, speculating on a decline.
Are those the
some money
same
if the market goes down.
positions? Is speculating on a decline and buying insurance the same thing?
No. Speculating
I
on
would
a
think
decline
speculating on a decline would be a little tighter and a little bigger, whereas
Yes.
insurance would be a little looser and a little less.
Yes. Right. If the market goes down 5, like insurances, I think this is going to go down, has a chance to go down 5% over the next month. And so let me buy puts that are 3 to 4% out of the money. And if volatility expands and we get a 2% move lower, those are going to go up in value. Right. The speculation is, here's a date on the calendar, August 1st, tariffs may go into effect. Let me buy something that if the tariffs do go into effect, this will make 5 to 1. And if it doesn't, then I just wasted $200.
Mm-hmm.
There's a slightly different approach, but we need to give homage to our.
I mean, because I feel like we haven't
here.
really had you in this side of the room, or even just sort of drifting to this side of the room for some time.
In February,
What are you gonna do when the tariffs don't come in? What happens when the tariffs come in as a non-event, and this thing lights up like a rocket?
I'll have no choice but to then get long.
All right.
But you're saying you do this before August, right?
I usually do delever in July. Like last year, the only thing I had going for me was an MNQ position, which I put on out of spite against Ilya. And so it wasn't like a well-founded trade. I remember talking about I'm putting this position on out of spite because of your bearishness, Ilya. And then I had to ride it out for the market to reclaim the highs, just to not admit I was wrong. But outside of that, I didn't have any trades going. So I'm not going to trade for spite this year. He's not here this week, so I don't need to be spiteful. And then again, Dylan, I got to give our audience credit. Our audience is very smart. Our audience for the past week has been telling me that I've been a bit of a jerk to Ilya, and they've been mocking Ilya. And when I get, is Ilya comfortable being short? Well, the last time I heard people making those tweets was in February. He was pretty damn comfortable being short in February. He felt pretty damn comfortable being short all the way to the April lows. He caught basically the Russell decline 15%. Just absolutely crushed it. And I'm seeing that same type of sentiment come in. I'm feeling in my own head, I'm feeling myself playing along with people when they ask me about it. And like, I love and respect Ilya. I've worked with him for now more than half my life as I crossed the 36-year mark this past week.
So it's an indicator.
Like a brother. Yeah, my own hubris. There's a reason why I keep saying Icarus flying close to the sun. I feel it in my own bones, how I trade. Like, I want to step away for a little while. I know I'm going to do something stupid.
It's too hot in the kitchen.
It's too hot in the kitchen. Do you ever go through that, guys? Like when you're on a heater and you're like, I know I'm going to screw this up, so it's better for me to just walk away. I have one trade in mind in particular. Gilead, 2014. I should have walked away. Very specific trade in mind. Gilead had just released their hepatitis C vaccine, which then they were going to give to the world for free, which obviously pissed off a lot of shareholders when you say you're going to give away your hepatitis C curing vaccine. But I was able to ride this up through out of the money calls all the way up into the hundreds. And then I kept pushing it in like late 2014 and I just kept giving away money, just buying more out of the money calls, out of the money calls, out of the money calls. It worked for a little while again, and then it just came crashing in. And it was a strategy that I had worked for 6 months, but I felt like, okay, this is getting away from me. Why am I putting so much on this? And then I started losing again. And it's kind of how I felt with gold in April. And then I've been doing the same thing for the past 3 months, just buying calls, not doing what Ilya did. He was selling puts. He made money with long deltas in gold the past 3 months. I have not. Little signs, Dylan, that you have to know within yourself as a trader. Like when I do this, I'm being too arrogant. When I'm too arrogant, I'm over-levered. When I'm over-levered, I lose money. When I lose money, I get humble. When I get humble, I make better trades. So I'm trying to short-circuit that cycle where I lose the money part now. Maybe I'm wrong.
That's what I was doing with Amazon 2017, just buying calls out of the money. And then 2018, I think Trump tweeted something about Amazon and it stopped working.
Jeff Bezos was seen with LeBron James over in Cannes this week. Dylan, does that mean anything for you?
Nothing.
Okay.
I mean, guys, for like Bezos is more detached from reality, in my opinion, than Musk. I just think that Bezos is really just entirely focused on managing his social profile as sort of world adjacent to being the world's richest man, with basically no interest or focus on anything relevant to commercial activity of any enterprise. Between that wedding and just hanging around in Europe, he's got his boat. Like, I just don't get the sense that his attention is relevant to anything other than his own aggrandizement in the public and in the tabloids.
Amazon,
which is what it is. I'm not even being critical of it. I just don't think that it is relevant. Like, I think Musk is still somewhat relevant to Tesla, for instance. I think Bezos is basically irrelevant to Amazon.
A report came out today that SpaceX leadership is telling investors that Elon Musk plans on staying involved in politics. Bezos he was at the White House last week, but you don't see Bezos making a dog and pony show of every time he talks to Trump. Whereas Musk, I think, needs that public validation. I did see a comment earlier. I don't see any proof of a trade deal with the Philippines. I just want to clarify this. I'm looking at Fox Business News. Okay. They have it quoted here. The Philippines will pay a 19% tariff. They're not paying a 19% tariff. We, the American consumer, the American business, we pay the 19% tariff to the U.S. government. Philippines are not.
And so that's a second 19% headline. That's on the stacking up on the Singapore headline.
Sorry, it was the Philippines, not Singapore before.
Okay, so that's just the same deal. Same deal.
Yeah, I just wanted to clear this up. It was
okay.
Philippines, not Singapore. So just to clarify
that we're stacking 19%. Now you're getting me nervous. If everybody's
I'm getting myself nervous. I just don't want to facilitate fake news. But it was important to
Singapore. It's Philippines.
It's important to get the country correct.
What do we import from the Philippines? I wonder. Sugar cane or something? I don't know. Wonder what the big
from the Philippines. Electronics, mineral fuels, machinery, vehicles.
Rubber?
Oh no, this is the Philippines. From the Philippines to the U.S. That's what we want to know. Electronics and machinery. Semiconductors, ignition wiring for vehicles, garments, coconut oil, textiles. Not high up the supply chain, but high enough.
Mm-hmm.
Either way, just wanted to make sure that was clarified because, again, truth is important around here for the moment. Guys, do you have any other comments here to close this out? I feel like today was kind of a blah day outside that little bit of a blip of a headline. I'm seeing my signposts that make me a little bit nervous, but gold's working, silver's working, Bitcoin is still working. One of the other trades, Dylan, we talked about getting long coal producers a few weeks ago and short healthcare companies that operate in rural areas. BTU, Peabody Energy, the company where we decided to stake out some leaps effectively, not quite because they're not over a year, but 178 days to expiration, long list 25, short the 30 call spread. That had a nice day today. BTU was up 8.89%. So it looks like the market, the liquidity, the speculative funding is flowing into the places where the tax cuts are going in this Trump bill. And that's beautiful, clean coal, as some people might call it. Something to do. Something to work with.
Something to do. I don't know. What about the bond market? If the dollar is going to go straight back in the shitter, what are we going to do with the bond along the way?
Thomas, doesn't it depend why? Like, if the dollar's going down because yields are going down, that's probably a good thing. If the dollar's going down because yields are going up, that's probably a bad thing.
Yeah, I mean,
we don't want the April dynamic.
That would be like a recession or, something going towards that.
We can't go back to sell America again.
I mean, you can,
but We could. We prefer not to.
No, I don't know. One thing is I got on my copper long today, and with the close, the end of day action there, I was wondering if I should have stayed in it, but
Copper looks real hot. Jeez. Tariffs, man. Copper tariffs, man. Is this all just tariff talk, Thomas? I can't help but reconcile that crude oil is lower on the day when copper's up. All the metals are up. Is it the anti-fiat trade?
I mean, the tariff impact is already over. So this is, I think this is the dollar going down, but it's looking stronger than I expected. I mean, I was still expecting it to go up because I was long, but.
Well, what do you mean the tariffs are over, Thomas?
I mean, the August 1st deadline, everyone who has had to import that copper over here, the time has run out to get any more over. So, I mean, they're not over, but the arbitrage and the movements between LME, COMEX, Shanghai, that's all been.
You're saying any positioning, the window for positioning is closed.
Right. Because those deliveries take longer than a week if you're going to do it. And if you don't get it in, you're paying the tariff.
But you're not suggesting. Do you have a speculative opinion on the credibility of the tariffs in general, relative to the again? Because for me, the market always seems so very comfortable with not really being that worried about it.
Yeah, I don't think it's going to be, inflationary or not inflationary to a great degree. But I'm going to be a little surprised if it keeps running higher at the current pace.
We've looked at the modeling for tariff inflation or the copper inflation as a result of the tariffs, and a 10% rise in copper prices historically has led to a peak bump in inflation of 0.05% 2 years later. So, I mean, does this, at the margin, does it help the Fed's case to cut rates? No. But is a 0.05% increase in inflation over 2 years at its peak something that the market's going to be too bothered by? Probably a worse story for corporate earnings for consumers of copper, but for us, the people at home, I don't know. That's a tough sell for me, even as someone who thinks tariffs are bad. A 0.05% increase in headline CPI is nothing. I want to be against it, but I don't see how this is going to do anything other than erode corporate earnings at the margins right now.
Yeah, I mean, you think copper
you mean
going
tariffs
up like
in
this?
general?
No, the copper tariff specifically. Other tariffs are a different story. Blanket tariffs on countries, other goods, one thing, but copper's a little bit of a different story. But, guys, let's leave it there because overtime is just about out of time for this Tuesday, July 22nd. We will be back tomorrow, same time, same place, every Monday through Thursday, 4 p.m. Eastern, 3 Central, right after last call. So for Dylan Radigan in Milan and Thomas Westwater in Chicago, I've been Chris Vecchio in New York. Good luck trading. After this, Ilya is back. Macro Money on Demand. Up next here on Tasty Live.
The churn in the financial markets continues. There does seem to be a little bit of an unclenching in risk sentiment. Bonds up, stocks up, the U.S. dollar idling. That follows some perhaps, maybe, possibly moderating rhetoric out of the White House, but the upshot of the situation broadly unchanged, and the key markets still at key decision points from the beginning of this month, and we'll have to figure out what the price action is going to tell us about that. So in the meantime, we are going to take a look at a broader view of what may be going on here and get back to our conversation about the diminishing confidence in the U.S. dollar, or so it would seem. We talked about why the current environment has been so negative for the US dollar, as we've seen a kind of sell everything US related kind of a dynamic since the beginning of this month. We've obviously seen stocks go down in the US, bonds go down in the US, and the dollar go down all at the same time in what has been a little bit of a change of pace, the dollar seemingly losing its capacity to rally as a haven on risk-off momentum or on higher yields. Those yields, of course, going up for the wrong reasons, but nevertheless. And so it bears asking, well, if not the dollar, then where? And if the currency world is not through its readjustment on the dollar, then where is there more room for this to continue? So we'll start this conversation here with a relationship that really illustrates why the dollar probably has more room to go down, even as we consider a kind of maybe preliminary unclenching of the issues that we've seen sort of hit the headlines and break out into markets. So this is a chart from the American Enterprise Institute, and it nicely distills what is the relationship between the U.S. trade deficit, ostensibly the thing we're trying to defeat with these tariffs, and its actual implications for what happens with the U.S. economy, and consider that actually what this is effectively a benefit and not a cost. And so consider here that what happens when this trade deficit is incurred, and that's the light blue line here, what is essentially occurring here is an outflow of dollars into the hands of foreigners. And that sounds bad, but consider actually what we're saying. Foreigners end up with a bunch of dollars having sold Americans primarily goods. That's generally where most American imports are. We take care of our services demand via domestic firms for the most part. So, and we're net exporters of services, actually. So on the goods side, we're, of course, net importers by a long mile. And what that does, because clearly nobody's getting on a plane to buy their made in China or made in wherever stuff, they're buying it at their local store here in the US. So foreigners, and of course they end up paying for it in dollars. So we're simplifying supply chains for the benefit of the conversation, but the upshot here is foreigners then end up with a giant pile of dollars. And the question then becomes, well, do you convert those dollars back into local currency and invest in your own economy, or do you keep it in dollars? And what has been happening, basically going all the way back to the dawn of this system, which follows the untethering of the dollar from gold in the early to mid 70s, is this idea and this understanding on the part of our trading partners that if they were to convert that pile of dollars in size back into their local currency and repatriate that money, what would happen is the dollar would, of course, fall, because that would amount to selling dollars. Well, and then the purchasing power of their consumers in the U.S. would go with the dollar, and they wouldn't be able to buy all those exports anymore, not nearly in the same size or volume. And so what has happened is a recycling of dollars back into U.S. financial assets. That, of course, is a huge benefit for the U.S. because, number one, it is a huge inflow of capital into U.S. equity markets, which helps finance U.S. corporates. Number two, it is a huge inflow into U.S. Treasury securities, which helps keep interest rates low for the government and for all of the consumer lending rates and business lending rates that use treasuries and treasury yields as benchmark, which, surprise, surprise, is nearly all of them. So what you're looking at then is the upshot of the current account deficit being cheaper U.S. borrowing costs, higher U.S. stock markets, better capitalized U.S. corporates. And of course, since most pension money is basically just market tracking the S&P 500, that's a benefit for everybody involved, even for, let's say, public sector pension holders. Indeed, the largest holder of U.S. equities is CalPERS, the California fund that manages the money of public sector pensioners. So you have a situation here where the halving of the trade deficit, that is more open commerce, and the thing that we're attempting ostensibly to fix, as a mechanism for putting dollars in the hands of foreigners that they then reinvest in the U.S., that, of course, makes the U.S. dollar stronger. Now, lest you say, well, this is only through 2015, a decade has elapsed since, surely this situation has changed. Well, not so much. Here is a view that updates at least the trajectory, and of course these are different magnitude things because we're not dumping all of the sums that are embedded here into this. We're just looking at the direction of travel for the theme. And you can see here U.S. foreign direct investment since the end of the pandemic has surged, which of course has been finding a mirror image in a widening U.S. current account deficit. Not surprisingly, of course, the U.S. economy has been the one that has grown most robustly of the majors. We've seen that time and time again, and you can see that again more recently. More foreign direct investment, even just in the past several years, and a steeper trade deficit. You might take issue and say, well, look, these magnitudes are different. This is some sort of chart art situation. Does this really hold? Well, again, these are not full aggregates. They're meant to show not the perfect relationship, but the trajectory of the theme. But let's take a look at the latest numbers from the U.S. Treasury Department and take a look at the sheer size of foreign holdings of U.S. securities, be it short-term debt or long-term debt or equities. And consider that this is in the trillions of dollars. So we're looking at somewhere in the neighborhood of approaching 30 trillion. Let's be generous and say it's somewhere between 25 and 28, something like this. And you can see that these numbers have steadily grown, and indeed since the pandemic they have actually become more dramatic, which of course is exactly what we find right here. So the essence of the relationship very much holds, and so it should not be any kind of a surprise that since the beginning of the year, as we were about to get an administration that very clearly presented itself as minded to close the trade deficit and to become generally more protectionist, that what you would see is a situation where the US dollar would weaken, because if you reduce volumes of trade, be it with tariffs, be it some other way, of course, in this case, it is tariffs. If you reduce the volume of trade, then you reduce the amount of dollars that foreigners hold. And then this dynamic starts to cave in on itself. If they have fewer dollars, then they have fewer dollars to reinvest. If you give them a reason to be concerned about reinvesting those dollars, then maybe they will be more inclined, especially if they anticipate that volumes of trade downwind are going to be reduced, and there's less of a reason to want to keep the dollar uplifted for purchasing power of your exports, because what the U.S. has done is basically blocked those exports before that's even a consideration. Well, then you might have an exodus out of the U.S. dollar. And indeed, as we see here, this is a chart of the U.S. dollar index, which is an average of the U.S. dollar's value against its major counterparts. And needless to say, I've decried the limitations of this thing, because it was constructed before there was a euro. And so all of the legacy currencies that used to make this a diversified basket are now essentially the euro, and this might as well be then the euro-US dollar exchange rate upside down. The basket doesn't include a China proxy like the Australian dollar, which at this point is the fourth most actively traded currency, according to the most recent data from the Bank of International Settlements, which we'll take a look at in just a second. But nevertheless, the thematic implications of what's going on here, those hold. The upshot of saying to the markets that we are going to try to close the U.S. trade deficit, and the way that we're going to do it is we're going to erect trade barriers that make it less attractive to buy from abroad. That's going to weaken the dollar. And the reason it's going to weaken the dollar is because this recycling of dollars from the trade deficit back into the U.S., that sort of process will be fundamentally undermined by trying to close the avenue by which foreigners end up with those dollars in the first place. And then, of course, comes the question, well, okay, so what then is the next step, and which currencies might you then expect to benefit? Because, again, that money has to go somewhere. Things are still going to be sold, but maybe there's not a reason to dump them back into U.S. markets, and maybe the volumes are less U.S. versus rest of world, but rest of world still has its wares to sell. And so capital is going to go, it's just not going to go into the U.S. So then which currencies ought to be the beneficiaries if the dollar is going to lose some of its quote-unquote market share? And as promised, here are the latest numbers from the Bank of International Settlements. They are as of 2022. That's the last update. They're on a triannual schedule, so we should get another update of these numbers this year. But as it stands, this is where we are, and these things are not terribly volatile, so this is still quite an accurate reflection of current reality. And you can see that the next most liquid currencies after the dollar are the euro and the yen. And of course, we can see the drop-off is absolutely staggering. And lest you think that the BRICS, which I've made into a grouping here, lest you think they're in contention, just consider how absolutely minute they are relative to the amount of monetary transactions settled in the dollars, and also consider that they are just a touch above only China by itself. So really, this BRICS number minus China is barely a rounding error and barely even visible on this chart. I mean, here's Brazil, here's Russia, India is over here, so and China's right there. So we're talking about barely visible amounts of volume, and this is not really a contender. There is no way that you could shove anything like a meaningful amount of U.S. dollar market share in terms of settlement payments into this. Now, when you combine the euro and the yen, you're looking at about 3.5 trillion. That's to the US dollars 6.6. So it's about half. So you might see, let's say, this big share of the dollar diminished down, let's suppose, halfway. Maybe, I mean, that would be catastrophic, of course, but let's say you could have room to reduce this by some measure, where the U.S. would be still overwhelmingly the dominant, because there's nothing even remotely close in terms of market size and liquidity and stock of assets to absorb all of this kind of liquidity. But you might perhaps see the tally here come down a bit and the tally here come up a bit. And of course, the problem with expecting the China tally to come up a bit is they don't have markets that are entirely open or even close to open. There are significant capital controls. Liquidity is non-existent in sort of any kind of practical sense, and it'll take a really long time to start to rival the U.S. in terms of financial heft, even though the economy is the world's second largest, just because of the way that capital is gated onshore. And so you're looking at the liquid alternatives where capital can move freely. And needless to say, the natural kind of alternatives that stand out are the euro and the yen. And with that in mind, it seems hardly surprising that those have been the two currencies that have outperformed against the dollar since the beginning of the year. These are percent change numbers for the benchmark futures for the top four currencies most transacted against the dollar. And you can see here it's euro, yen, pound. China's capital controls taken out of rotation. The next one is the Aussie. And those are the four that you see here. We can see the Aussie has lagged. The pound has lagged. The euro and yen have added north of 10% apiece. You might say, well, why are we talking about this now? There's already been a massive rally in these currencies against the dollar, and if anything, they're starting to pull back a bit. We were looking at gains of as much as 12% only a few days ago. Isn't this move over? Well, in my mind, that's the perfect time to be talking about this, because if there is some sort of a near-term correction in this, then what it offers is an excellent buying opportunity. And the time to think about it isn't when that buying opportunity has already appeared. It's when you anticipate and you can prepare for it to actually show up and have the capital and the key levels in mind to actually make that into an actionable thesis. Because indeed, this is not the kind of thing where the dollar sells off because maybe President Trump is going to attempt an extrajudicial firing of Chair Powell. This is not the kind of thing where you get an episodic response to maybe a trade deal with China, maybe not, depends on who you ask. If you ask Treasury Secretary Scott Bessent, a deal is inevitable. If you ask Chinese officials that commented overnight, nobody's talking to them and there is no substantive discussion, and they have no idea what the White House is talking about. Obviously, we take both things with a grain of salt. It's a negotiation between rivals. They're attempting to paint the tape their way. So as we look at all of this, the upshot is, beyond these headlines, is there a structural direction? And I think clearly, as we see from the trajectory of the dollar going all the way to the beginning of the year, there indeed is. And we've gone up and down along the way here, but the trend is the trend. And what it reflects is this structural unwinding of these dynamics. And so while the dollar may be done falling here in the near term, the trend remains and the structural underpinnings for it continue. In the most sort of hands-on practical sense, we still are looking at sizable interest rate cuts for the U.S. this year and next, looking at about 110 basis points at this point. Cumulatively, not surprisingly, that tally has increased significantly since all of this concern around the tariff rollout has hit fever pitch late February, let's say, up through now. The expectations have become increasingly more dovish. But against that backdrop, the situation in Europe is quite different. First off, we're looking at less of a tally, so less by about a rate cut than what we have for the U.S. But more importantly, theme-wise, we are starting to see over the recent months, really since the beginning of the year, the idea percolate that maybe next year is a year for rate hikes out of the Eurozone, which would only make the U.S. dollar weakness argument stronger. Because, of course, then yield differentials in a very classic way would shift against the dollar. And this idea that maybe we're looking at rate hikes next year, this follows Europe's seeming conclusion that the U.S. security blanket is now unreliable and that NATO ex-U.S. needs to arm itself. And so there's been a dramatic push, especially in the Eurozone, to spend a bunch of money to rearm. That, of course, is going to be a boost to both growth and inflation, and the ECB is going to have to approach it as such. And so we've seen a sense show up here that the sort of rate differential that maybe favored the U.S. dollar this year, however ineffectively, will actually invert on it next year. That, of course, is something markets might front run as the dust settles. And, of course, for the Bank of Japan, the story uniquely amongst the major economies has been of rate hikes. We can see on the bottom here the spread between the current implied futures curve, that's in the red here. It was a little bit more hawkish a month ago, but nevertheless, it still points to hikes. We can see the difference going into the back half of this year between the current target rate and what the curve implies is positive. That is to say, we are looking at rate hikes into the back half of this year from the Bank of Japan, and that really should be something that makes quite a bit of sense if you consider that we just got PMI numbers this week out of Japan that, unlike many of the other major economies, were blisteringly strong. And so the argument here still seems to favor a U.S. dollar that weakens as U.S. trade policy gets more protectionist, and the euro and yen as the likely winners from that for months and quarters to come, if not perhaps just right here. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Chris for Futures Power Hour tomorrow, back with Victor and Tom for First Call on Sunday, writing for the News and Insights portion of tastylive.com. com, opining at Ilias Pivac on the platform formerly known as Twitter, and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Class is in session. Dr. Jim Schultz is bringing the heat to Options Crash Course Live. This 90-minute show features Dr. Jim in his professional prime. All of the gimmies, none of the gotchas. Come early and grab a drink with Dr. Jim before class and stay for Q&A. The event is free, but space is limited. Register today at tastylive.com/events. It's not a lecture, it's a lifestyle.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
Global markets never sleep. Explore them with Forex, now available on Tasty Trade. Get in on over 80 Forex pairs, 24 hours a day, 5 days a week, with the Forex platform that adapts to your style and speed. FX marks the spot. Trade it on Tasty Trade.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto, we got it, we get it.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Got a little bit about vending machine cars, Carvana, we're going to touch on today, get into the weeds, the details about that. But before we do, Gus, what's going on, brother? How we doing? Tuesday.
Yeah, excited to talk some Carvana. Aaron and I have become quite the Carvana bulls.
I know.
In the last 24
Unintentionally.
hours. Unintentionally. We just started having a conversation and figured out we love this company. So excited to get into all of it. But yeah, I'm doing well. All my positions are up today. This was an interesting day. I've been talking for months about how long Delta I am. And so usually that means that if my portfolio does really well, that means the market is also doing really well. Weird day where there wasn't any cataclysmic move in SPY, but just pretty much everything moved the right way for me. So I can't complain.
No, I hear you. A lot of movements today, a lot of volatility. We had a pretty aggressive sell-off. I think yesterday we had a pretty big rally yesterday, pretty much consolidated for a couple hours, sold off into the close, had a continuation to the downside today, and then pretty much rallied since there. So we'll see what we get. The portfolio was looking really good the beginning of the morning, and then towards the end of the day, as you know, I lean a little bit of short delta. So whenever the market's ripping to the upside, probably, it's going well on your end. Whenever the market's ripping to the downside, it's going well on my end. So that's kind of where we're at, but I'm excited to
We got to both just start being neutral.
Or we're hedging.
We got to both just start being neutral. That's true. Somebody has to be right. Somebody has to be having a good day every day with us. Exactly. Time to turn on your Errol Coleman chart settings. Real. You guys ready for some candles you can't tell the difference between? It's awesome.
Oh, yeah. Pretty much. Oh, is that the black and white? It went over my head.
The black and blue, yeah. Is that what it was?
Yeah, it was either black and blue or black and purple.
It was white with black and blue, yeah.
It was easier to see. If anybody doesn't know, I am not colorblind, color deficient. It's where you can see colors, but depending on the shade, it looks like a completely different color. So
I just don't understand that with that in mind, which I did know, but with that in mind, how in the hell are colors that are hard for me to tell the difference between easier for you? What does that even mean?
Right. No, I mean it's I still don't know what's going on over here, but what's going on, guys? I hope everybody else is doing well. I know. See, Luis used to love Carvana stock. It's what I was saying earlier today. I was like, that man loves Carvana stock. He's probably the one pushing this thing higher. So we'll touch on Carvana. What's going on? Big deal. Emmett, Bob, everybody. Anything new before we get into the segment for today, though, Gus? I mean,
man, Rocket Mortgage.
Rocket Mortgage, it's ripping.
It is ripping.
We could touch on it on Thursday. I don't know. We'll see what else pops up until then. But
yeah, it's true. But I do have a long 3 DTE 20 call in Rocket Mortgage. That thing has been moving like crazy, and especially post-market today. Shout out Wall Street Bets for getting involved with that one. But yeah, that's kind of been my main point of excitement for the day outside of this Carvana stuff that we're going to get into here.
No, I mean, I love it. We'll see how Rocket Money pops off for the rest of the week. I know Tom's been touching on it too, getting into some of those things, but let's get into Carvana. Does anybody watching right now have any thoughts on Carvana? Owning the whole stack is a headline for the day because Carvana is doing some things a little bit different than others might. I mean, they're stepping into a new territory. And they're trying to squeeze profit margins in areas we haven't seen competitors do. So any thoughts right off the bat on Carvana, or what were your original thoughts when you heard about Carvana, a vending machine car thing? What is that?
Well, yes. I mean, as a car vending machine company,
right.
I always thought it was kind of just a novelty thing, something they're trying to sell cars a slightly different way, take advantage of some novelty, and kind of sell you an experience as well. You get to go to the vending machine and watch your car come down, and this feels like this thing out of the future. But what we've started to stumble into here, and as we're about to get into in the slides, is that they are way more than a car vending machine company now, obviously, which was no secret to either of us, but they're buying and selling cars online. And so that led us to the question of, man, everything is online. All shopping is going online. Brick and mortar is dying fundamentally. I mean, across the board.
Right.
And so why would you not be interested in the company that's now selling cars online? That's a new frontier of online purchasing, something that isn't widespread yet, but I feel will be. So yeah, excited to get into it.
Yeah, I mean, right off the bat, I thought Carvana was one of those things that was like, it's kind of gimmicky. It's like, okay, we had Redbox. That's kind of how we got into the conversation yesterday. We started talking about Redbox, that vending machine type model, and then we thought about Carvana, like the vending machine vehicle model. That's how we circled around to that conversation. But it sounded gimmicky to me. Before I looked into the details, I'm like, I've never seen one of these before. Luis kept bringing it back up every other week, maybe every week, and then paid a little bit closer attention to it. So that was kind of my thoughts when I first heard about Carvana. But we can get into the slides here.
Hey, Lone Sophos, good to see you in chat. We would love an hour. We would love an hour-long show.
Oh yeah, we would love it. We would love it.
we appreciate everybody making noise for that. But yeah, Carvana, buy cars from people, essentially, however they so choose. Trade-ins, direct purchases, lease returns, fleet operations, and most notably, I mean, I believe one of their largest revenue segments is just, purchasing cars straight off of people.
Yeah.
This matters because they are cutting out traditional middlemen. We're going to say vertically integrated like 100 times in the next 30 minutes. Everybody strap in. But vertically integrated, it reduces their acquisition costs. And with all of these different channels to acquire cars, it gives them great inventory liquidity. And as we're about to get into in a bit, it helps that they don't need physical dealerships to house all of these cars at. So yeah, it's full vertical integration. Cars in, cars out, most of it happening on the internet. And I mean, sidebar, one of my close friends just sold his car to Carvana, which was another part of what spurred this conversation for us originally. But he had nothing but amazing things to say about the experience. He said they beat the market price somehow. They just sent him a little lockbox, threw his keys on the side of his truck, and they came and picked it up. It was super seamless. That's in the middle of downtown Chicago, probably one of the hardest places in America you could possibly 100%. Have to put a car on a truck.
That's a testimonial right
there.
Yeah. That's an ad.
It is.
In Chicago.
Yeah, but it works. This stuff really works, and they are able to somehow give better prices than the market a lot of times when you're trying to sell your car.
Yeah. Pretty much what Gus is saying is if you guys haven't seen the company like myself yet, it is real. It exists. It's not just photos or AI, but they're doing things a little bit different, trying to cut on costs, different model, trying to cut out that third party middleman, which a lot of businesses end up doing so.
Yeah, and I think Scramble hit the nail on the head in chat here. The vending machine is the ad. The home pickup and delivery is the bread and butter. And that's true. The vending machines, you drive by them all the time, and you're like, oh, man, look at these cars way up in the air.
Right.
They don't really care if you buy from the vending machine or not. They just want you to be aware that they're there.
Right. I mean, it's great marketing. It gets your attention for sure.
Absolutely.
Yeah. We go ahead and jump to the second slide here. Inspection and reconditioning. All vehicles pass through one of Carvana's IRC facilities, inspection and reconditioning centers where they're cleaned, repaired, and prepared for resale. So I mean, right off the bat, in-house again. They're trying to do everything themselves. They have a little bit more leverage.
Yes, and this is no different from what a conventional dealership would do when they receive a car. But the difference is that Carvana is able to do it at such quantity. They are able to, instead of just having one dealership where you have 3 people who are your cleaning people and you have 6 cars come through a day, I'm sure that there is a large facility somewhere with hundreds of people that work at it that are handling all of these things, and it makes for quicker turnover, it makes for cheaper cost. It just works better at scale.
100%. And again, like we kind of just mentioned, at scale, the scale and consistency are hard for smaller players or dealer groups to replicate, because it's like, if that's the case, why not just do it? Or why weren't they doing it 5 or 10 years ago? I guess there's a little bit of a bottleneck there.
Well, and it's also, I mean, we discussed this yesterday when we were talking about doing this segment. It takes a lot of infrastructure setup. You have to there's a lot of capital required up front to actually establish the infrastructure that you're able to do this. Because if the closest service center was in Des Moines, Iowa, and Chase sells his car to Carvana and they have to take it all the way out there, all of a sudden you incur a bunch more costs. But all they have to do is go out to Oaklawn and they're there. So, yeah.
Convenient. Third slide here, retail sales. What are they talking about retail sales, Gus?
Yeah, retail. We lost it there for a second. That's all right. Anyway, yeah. So pretty much full online platform here. The vending machines still do exist and you can go, but pretty much 100% online through Carvana's platform, which is very robust. If you've never done it, go poke around like you would with Zillow or something sometime when you have a second. 360-degree photo tours, vehicle history reports, financing offers. They show you the car facts. Yeah, they show you the car facts.
Sold.
So yeah, and as I alluded to earlier, they don't have to have physical showrooms that they keep up and maintain and keep ready for people to come to. That keeps your overhead way down. I mean, when you can just, you can just buy some huge tract of land in the middle of nowhere and throw thousands of cars on it instead of having to have this nice street-facing dealership that can only fit a few hundred cars.
Right, and then again, I mean, opportunity cost. It's like that's
location does not matter. They can keep these cars wherever they want. The very, very cheapest place.
That's another good point. And just to piggyback off of that, I mean, with the brick and mortar style, I mean, just traffic in general is going to be an issue. Getting noticed, like you kind of just said, and then on top of that, being able to use all that funding. I mean, it takes a lot of infrastructure to build, and you need capital to do that. I mean, you can use that in the technology that you need to do these 360 video cams, whatever you use to show off those vehicles. I know whenever I was looking for a new place out here in Chicago, even just being able to look inside a building without having to physically be there is just completely different than 10 years ago. Not that I was looking for a place for myself 10 years ago, but I mean, those things that they have set up to where you can go and check out the unit. I don't even know what they're called, but it's those cameras.
Yeah, like the 360 cameras.
360 cameras,
you'll see people use them like on motorcycles, like on the stick
100%.
or whatever. That's the more popular use case. But yeah, they absolutely work for this, and it's only getting better. And you can just augmented reality your way through the whole place. It's very impressive. And then the last point, enhances conversion, and that's true. And the UX is just so good because if you're shopping for a car, typically you have to go to, you're looking online. Obviously, cars are available online, like you can see what different dealerships have. But still, the process is going to be find a car you like. You're restricted to cars that are just within a 2-hour radius of you. You got to find one that you like. You got to go out there. You got to test drive it. You got to go through all the rigmarole of haggling with whoever, and then do the title, all that stuff, and it all has to be done at a physical location. And if you go there and you test drive the car, or you figure out the price is different or whatever, and you don't like it, you have invested a lot of time and for no return. Whereas if you go on Carvana, you can look at 50 cars in an hour if you so choose, and they're all available to you, and you take out all of that headache. So it is just, it's just way better user experience than typical car buying. Car buying is just a stressful thing. And I feel like this takes a lot of the stress out of it.
100%. And I think, runner-up is buying cars. I mean, moving homes causes a lot of frictions, and that causes something where people don't want to do those things. So if you can create something, you can create a solution that reduces a little bit of that friction. I'll go buy the car. I'll go do this if I have the means to do so, or I'm not going to push it as much as somebody typically might. So if you can reduce that friction, I mean, consumers are going to love that convenience.
Well, yeah. And I mean, now that I'm privy to how nice this is like absolutely an option I would explore the next time I need it.
And well, on top of that, a very close friend of yours had a great experience. That word of mouth is powerful too.
Yes, which absolutely. I mean, that word of mouth is a large part of why we're sitting here preaching to the masses.
Talking about.
So yeah, exactly. It's all word of mouth.
Financing. Carvana underwrites auto loans in-house. Oh, we can jump to financing. What a little quick there. My fault, guys. Carvana underwrites auto loans in-house and securitizes the loans for resale to investors. So in-house, again, we're almost coming back to they do everything in-house. It feels like that's the theme of all these slides. They earn interest income on top of the profit. So Gus and I were sitting down yesterday talking about how is Carvana increasing their profit margins larger than their competitors. And on top of that, we were talking, I was like, maybe they're not even profitable yet. And then I think we went back and did our research. They were profitable this Q1 of this year
was their first
time.
Quarter. Yes.
Right. So, I mean, they're doing well. So we were like, well, where else are they making some money? I think 77% of their profit margin came from buying and selling vehicles and fees, if I'm not mistaken. And then the other 20 to 23% came from things like having everything in-house, like their own financing and things of the sort. So controlling the financing, data from the transaction, and they're going to be able to keep all those little details and not have to outsource or split any of those fees for the middleman. They get to keep everything.
Absolutely, yeah. And as you alluded to, what we discussed is how are they able to beat the market when they are buying a car from you, and then also beat the market when they are selling a car to you. And it's because when you do in-house financing, you could do those things at the same price.
Right.
You could buy a car for 40 grand and then sell it for 40 grand. But if you finance it on 4 years at a solid interest rate, you're going to make money on that vehicle.
Absolutely.
And so that's a major advantage that Carvana has over the competitors as well, is the in-house financing.
Right. Last slide we got here for Carvana. Delivery. This has to be like the cherry on top for Carvana, because this is like you're building out kind of a new infrastructure. Hopefully this works well. The delivery is the last part. If someone has a bad experience on the delivery portion, they might not choose to use you again. So I'm excited to get into this slide.
Yeah, absolutely. So yeah, you buy a car on Carvana, they can bring it right to your door if you want, or if you would like the novelty of a vending machine, that's also an option. They'll put it in a vending machine for you and you can go pick it up. But they again, vertically integrated, own most of their logistics network, which allows them to, have tighter control over all of these things, lower cost per delivery. You're not outsourcing. You're not relying on availability of whatever trucking network you're contracting. Instead, it is just their trucking network. And that extends to every different facet of the business. No dealership delays, no showroom wait times, no other friction. Again, just the stress I talked about with buying a car. It sucks. Nobody likes doing it. You got to go there. You got to put on this whole facade that you don't like it, so they won't jack the price up on you. And then you got to do the negotiation and see what you can make happen. And it takes out all of that. And not to mention your entire shopping experience. You also already know if you're pre-approved. You straight up, you have your budget from Carvana. They're saying this is what you can afford, and it just makes all the guidelines that much easier. And so, over time, delivery density in metro areas reduces marginal delivery costs. That's absolutely true. If you can put 5 cars on a truck and go deliver all 5, that's cheaper than putting 1 on a truck and go and deliver just that one. And it's a big snowball as more and more people use Carvana. I was about to say the dumbest thing in the world. I was going to say it'll become more and more profitable. More and more people use it. No, their margins will increase as more people use it, which often, especially in businesses at scale, is the opposite of what happens. You'll see margins get smaller as you start to operate at quantity. But this is the opposite, where as there's increased adaptation, their margins are actually going to grow more.
To your point, though, I think the more people use it, not necessarily maybe the more it will become profitable, I guess. I mean, at this point, yes, because they're headed in the right trajectory. But before, depending on where that curve is pointed, scaling at the wrong time can either get you there quicker, regardless of which way that's in.
Yes.
But anyways, I know this really just sparked our curiosity yesterday, Carvana. And I think looking at the numbers don't lie. So it did shift my perspective a little bit on just the overall. Not that we care about the underlying, we just care about the IV, risk reward, probabilities, those kind of things. But from a fundamental level, I'm not gonna lie, it did shift my opinion or just outview on Carvana or those type of business models for other competitors moving forward.
Yeah, and it's only, obviously this is large, but it's only a $50 billion company right now. That's still plenty of room to the upside.
Just a small loan of $1 billion.
just something little, but it's only a $50 billion company. I mean, that leaves plenty of room for expansion. It's not like they're starting to hit the ceiling, and it's not like traditional car dealers have even started to at least immensely feel the effects of Carvana. But I do think that is a shift that we will see happening the same way that, your Macy's, your Kohl's, your Target, your Dillard's begin to fall by the wayside. I think that we could see that same sort of trend happen with car dealerships over the next 5-10 years.
Yeah. So got Luis. What's going on, guys? What's going on, Luis?
Luis.
Carvana.
Mr. Carvana himself. You missed our whole presentation.
No doubt. We can go ahead. We have a couple minutes left here. We can go ahead and jump to the platform, kind of see what's been going on over there. I know RKT was popping off a little bit over there today. I know Thomas had some calls on that, so he's going to be happy if we sustain any of that move into the after hours. Other than that, anything significant catching your attention?
I didn't realize it was my screen we're on. Yeah. Let's see. I got the rocket going. A little bit of exposure to crypto. I got some ETH. I got this IBIT. Bitcoin moved a little bit today. That made a nice move for me. But yeah, just a lot of green across the board. I'm still bag holding this UNH. Surely it'll recover sometime, right? It's not like their CEO died or something.
Got to at some point.
Yeah, and then Surf Air actually got a little bit of life right up running into close there. Got back over $5 for me, but yeah, nothing super exciting. I do have 2 Wall Street Bets plays open right now, which is 2 more than I would ever like to have open at a time. But yeah, I'm short Kohl's. This is post Wall Street Bets pump. Right. I'm gonna play that on the way back down, and then Rocket, as we alluded to, has just been absolutely ripping to the upside. Look at this thing. Closed at 1601 today. We're up to 1680, touched 1725 in after hours trading. So hopefully this will open tomorrow very profitable for me. Theta is going to take a nice bite out of it, but we will see what happens.
Kohl's is another one that just goes down and under. It's one of those that's like, yo, I forgot about Kohl's. Yo, I haven't heard about Sears in a while. Yo, I haven't heard about, and Kohl's met its demise from the stock market point of view.
Malls, really. Like in a broader context, malls are just dead, which is kind of a shame.
Yeah. I mean, whenever you went to a Kohl's or were familiar with the Kohl's growing up, was it in a mall or was it separate?
I would say in large part it was in malls.
Was it? Okay.
Or at least in some kind of large strip center.
Right. 100%.
I don't know that I've ever seen a freestanding Kohl's, but yeah, like Dillard's and Macy's especially, like those are mall destinations to me. And yeah, if you're not in a high foot traffic area now, malls just aren't viable.
No, I mean, it was a hangout spot in middle school. I think we touched on this not too long ago. But I mean, I don't know what the change is. I know we have the e-commerce, we have this, that, we have consumer behaviors have changed too, but I don't know. Those brick and
I mean,
mortars.
it used to be sweet, man. Your mom gave you $20,
Right.
let you go run around.
You left with a new T-shirt, lunch from the food court,
Yep.
and maybe like some type of knick-knack. $20. That's all you needed.
Yep. You
all you needed.
go into like Spencer's with your friends and fucking
Exactly.
just giggle at everything.
Just
like-
giggle.
Yeah, exactly. And yeah, that entire concept has largely fallen by the wayside, as I said, outside of high foot traffic areas in cities and stuff.
100%.
Malls are still a viable option, but
QCOM. Take us through QCOM. What's been going on over there?
nothing.
Nothing?
is what's been going on. This company, yeah, it's so frustrating. We just have like one retest after the other of this 170 to 180 range, and it never finds a breakout. It's so annoying. I mean, look at this. Look how many times we are testing 180 through here, and I've just never managed to get the breakout move to the upside. My most vulnerable position in that regard is this August 15th. That's 24 DTE now, which, dang, this year's going by fast. But 24 DTE 170 call. That thing probably dead in the water. We'll see. I'm giving it till the end of the week. We can reevaluate from there. But it did take a nice little dip right in here. Well, no, sorry, that's Liberation Day. I'm on 1 day candles now. Right in here, rather, earlier this month. So while it was down near 150, I did get short a 130 put, which I feel good about. And then I also have a 250 leap, a little bit of a gamma play into June of next year. But yeah, I'm waiting on the breakout. This isn't a TA trade. I like Qualcomm as a company. I think that they're kind of the sleeping giant in the AI space right now. Snapdragon is being used by everything. Snapdragon is going to be all that Android has to integrate AI into their phones. They have an exclusive contract there. I think all that's going to do really well. I just think that, especially in this day and age, hype matters a lot and the media matters a lot.
Right.
And so it's just going to take a few earnings calls to like finally assert to people that this company has the legs. But I do think that there's future upside for it. I need this breakout so bad, and it just keeps trying and never moves.
If it's going to be affected by any type of AI news, I know Wednesday Trump is going to be having he's going to be unveiling the AI action plan on Wednesday. So I know I'm going to be taking a look at like the NVIDIA position that I have on just to see how that might affect any type of underlying that might affect like chips, AI, anything in that category. So I know that'll be Wednesday. Maybe we get a little bit of a shakeup and QCOM starts moving a little bit.
Yeah, sidebar about Kohl's. Yes, the Amazon returns counter is definitely busier than
I
the
did
rest of the
peep that.
store.
That's crazy. I did see that right
Yeah,
there.
and I think that that's a very smart move that they made. I was actually working at a UPS store in high school when they first started taking the Amazon returns at Kohl's, and I remember thinking it was a good idea then, and I think it's a good idea now. I mean, you have to find a way to get people in the door somehow. I know that JCPenney did a partnership with Babies R Us, I think, try to stimulate some activity there. But yeah, the big box retail stores are just kind of coming apart at the seams.
Oh, it's rough.
But anyway, to your point about AI, I became privy to the fact today while writing an article about IBM that this company has been having an insane year. I didn't realize the absolute tear that IBM was on this year, better year than Meta, Microsoft, and NVIDIA. This is insane. It's done 30% so far this year. They have earnings coming up tomorrow after the close, but just quite the run out of IBM here. They're quietly doing a lot of stuff with AI, which makes sense. I'm kind of kicking myself for not seeing this like so much sooner because IBM, they were the first ones to AI. I mean, I remember watching Watson on Jeopardy in 2011. Like that was a big deal. And that was like the first time I ever heard the words artificial intelligence was right around that time. And so they were obviously at the forefront. I should have been more wise to see that eventually they had to catch up in the AI space. But yeah, IBM having quite the year. Boomer stock, as I like to call it.
No, they're moving. Let's go to check out the options chain real quick. What are they looking like? Earnings after the bell, July 23rd.
Yeah, what you want?
August 15th, just real quick. Let me hop in there. Not bad. Just seeing what that was looking like.
Yeah, not bad. Nothing's too wide. I don't have any particular ideas for earnings.
No, I'm not going to do anything in earnings. I might look at some type of post earnings, see how it digests.
Yeah, it's possible. If I was going to do anything for earnings, I would trade it to the upside just because they've been having this good year and I think their financials are going to be good and it's in this little mini breathing period right now. So I feel like there's more potential for it to move to the upside than the downside, but I'm not going to play with it. But yes, if there's some kind of overreactionary move, or I mean, especially if it takes a downside move after earnings, I'd be very interested.
I'm really just hung up on that unveiling of the Trump AI action plan, just to dissolve some of that uncertainty. It's just right tomorrow, and then on top of that, we have earnings for IBM. So I think these next 24 to 48 hours is going to be pretty telling for the AI space in the short term, at least.
Yeah, absolutely. IBM Watson was the first artificial intelligence. I'm being taught by chat. Scramble everything you bought at 120, brother. why didn't you text me? I would have been right there buying it with you at 120. Great investment at 120. Obviously, well over.
He's like, yep, old news.
But yeah, I should have seen that coming. That one missed me. And I was just joking with Nick Batista earlier today because my last semester in college, which was less than a year, 7 months ago, more or less 8 months ago, I had a class, I forget what it was called, maybe public finance or something like that, but it was essentially just a stocks class.
Right.
And we like day one was like, what is equity? We barely got on derivatives at the end. Like last few days of class, we talked like call and put.
What was that whole thing? Is that what everyone talks about when they're talking about we did this thing with stocks? Is that what you're referring to?
How do you mean?
You said you did something with stocks equity 6 months ago in school?
Yeah. Like I had a class.
Right.
It was, yeah.
And how was that? How did that class go? Is that same stock class everyone talks about they took, or is that a different?
I don't know what you're talking about.
I feel there's a class that people take and they're like, so like Liz and Jenny were even up and they're like, my boys asked me what stock they want me to tell them for their class because they're having this gaming class. And then Terrell did it when he was in school, my little brother. So I was like, is that the same thing or is this like an actual class? What am I missing out?
Interesting. We certainly never had to make a pitch. It was actually something that I outlined on the show a few times while I was doing it. But yeah, we did have a like semester long competition where we had a paper trading portfolio on Market Watch and everybody got, I think like $250K to start. And there was a bunch of regulations on how you could use it. But I wound up winning that thing because I had, I believe, Yang, which is the Chinese 3X inverse ETF, and they did a 12-to-1 split.
Yeah.
But Market Watch did not. They didn't
update it.
Yeah, they didn't update it. They didn't update my shares. It was an inverse split. That's what it was. They did a 1-to-10, so the share.
They didn't
price,
update the data, or they didn't update your.
They kept my number of shares constant. They did a reverse split, a 1-to-10 split, so the share price 10x, but it did not divide my shares by 10.
Wow.
So then all of a sudden I made like it was insane. I made like $1.7 million on this $250K portfolio because Market Watch was stupid, but. Yeah. Anyway, my point is that entire class, my professor, he was an older guy. He had been in the pits for like 20 years, and then he was just teaching for fun, basically. But he would always, when he needed an example for a stock, he would always use IBM.
Really?
And every time he would throw out IBM, I would always kind of chuckle to myself and be like, nobody trades IBM anymore. Nobody cares about IBM. Say Apple or something get with the times, old man.
Right.
And what do I know? This the old man was absolutely right. IBM to the freaking moon. So yeah, just I've been kicking myself for that because around the time he was talking about IBM, it was probably like sub $100. A
few minutes before we head on out of here, I seen a comment. Possible PDT rule elimination next year. Thoughts on that? It's about time. I have a hard time believing personally that they put something in place to protect us from ourselves in the first place. I have a hard time believing that. So I've always been a proponent of, I think that's a pretty stupid rule. I need your quick take before we hop out of here.
Yeah, I mean, it's not going away. They're just taking it down to 2K is the requirement instead of 25K. So like, sub like 8% of what it was before. I think that's right. And I mean, I think 2K is like a pretty fair amount of money.
I mean, that's the same amount you need for a margin account.
My concern is that 2K, I feel like if we're going to go 2K, we should just eliminate it entirely because 2K feels low enough to me that if you are the type of person that rule is trying to protect and say you have like $1,200 that you want to trade with, it seems to me like people are going to be more inclined to be like, oh, I'll just deposit the extra 800 and get to 2K.
That's a good point.
And then I'll be able to.
But at the end of the day, I want to take the conversation. Is it even about our safety in the first place?
Sure. You're saying is it just us versus them situation?
I'm saying was that put in place to protect us in the first place?
I think so. I do think
you do think so.
Yes. I mean, I think that is the goal. And as someone who's blown up a number of accounts trying to day trade with a small balance,
100%,
I can absolutely see why it exists. But at the same time, man, it's a freaking free country. If people want to blow their money, and the big thing to me is just with all of the gambling legalization, it seems ridiculous that we still have this thing on finance.
Well, that's my
safer and much more predictable.
That's my point into the fact that I don't think it was for safety in the first place because you allow us to do X, Y, and Z.
What do you think it was for? What's your conspiracy? I mean, are you saying that it's just like the
I will come back with a supported argument here on Thursday. We are running out of time here, but I don't think it was for our safety. And I'll touch on that a little bit more on Thursday.
Yeah, we'll have to pick this back up on Thursday for sure.
Anything else to add before we hop on out of here, though, guys?
Yeah, no, nothing. PDT rule elimination will result in a lot more blown accounts. I agree, but also that's just a lot more learning.
But I mean, I think that capital is going to be lost anyways. I think us being able to sign $50,000, $100,000 worth of debt at 18 is a sign that I don't know. I think I see a conflict of interest when it comes to for your,
Sure. I mean, I think people should be able to do whatever the hell they want with their money. Yeah. And I do think that blowing up accounts is how you learn and get better at these things. So maybe letting people blow up their $500 accounts a few times before they have the 25K is a good idea.
But the thing is, I blew up my $500 account already when I was in college. I feel like it's almost I feel like it's not going to matter.
Well, yeah, and with Polymarket and with sports betting and with all the gambling legalization and everything, there is a million and one ways to lose your money. Why are we protecting people 100%. From just this one?
Lastly, when I was in college and I was trading, I would over leverage because I only had 3 trades in a week. So it caused some bad habits in other areas too.
Sure.
So
it's a good perspective.
Yeah, I think good conversation. We'll circle back around to it on Thursday. Absolutely. Thanks for taking the time to hang out with us today. We'll see how Carvana pans out. Carvana long term, I don't know. We'll see. That's going to do it for today. Thanks for hanging out with us, and we'll catch you in the next segment. Peace.